Hi, everybody. Thanks for joining us today. I'm going to be hosting and talking a little bit about why right now is the best time to lock in lifetime income, really in the 20 years I've been in the business, maybe ever. The goal here is to use math. We're going to walk through some thoughts as to why an annuity can be beneficial to a financial plan, why lifetime income with an annuity really makes the most sense right now, and maybe some of the ways we should look at some of the older annuities you have on the books. You might be thinking as you're going through this webinar about some clients to maybe think about are people nearing retirement, clients that are already retired. A lot of the things I'm going to walk through are just very, very simple points as to why an annuity may be a great fit to replace a piece of that bond portfolio. So if you have clients that have tended to shy away from annuities, that haven't purchased annuities, right now is really the best time to talk to them about it. It might be 10, 15, 20% of their money. It's something to generate some foundational income. But as I walk through these points, we can make these slides available to you. I think these are all simple things that you can talk to clients about to help them better understand how an annuity can really be a very simple vehicle, but can be very, very effective at helping their other assets and helping their stability in retirement. So a big part of this is where we're at in the interest rate cycle. So my business partner, Dan, is an actuary. He did this big study on interest rates all the way back to 3000 BC. So as you can see, we've got in the orange line here, long-term rates, and the blue line, short-term rates. Short-term rates tend to bounce all over. It tends to be what's talked about in the media. Long-term interest rates kind of tend to exist in this corridor, sort of 3 to 5%. Outside of the interest rate bubble of the 80s, generally we see that 3 to 5%. As you can see, as we look towards today, I think we've got a little typo here. We weren't able to get to 2035. But as we look towards today, we are really at about the peak of where long-term interest rates tend to exist in this corridor. So when you look at it, when you consider the fact that many people think interest rates are just starting to fall, we're just starting to see a couple of insurance companies sort of adjust rates downwards. When you buy an annuity, you're really buying a lock looking forward on 30 years of interest rates at today's rates. When you think about how the bond market works, and this is a study, I thought it's just an interesting piece from 1953 to 81 when interest rates were rising, 81 to 2020 when rates were falling. As you can see, even though we had about the same interest rate cycle here, as most on this webinar knows, when interest rates rise, bond values go down. So during this period, the average rate of return for all bonds was 2.48%. From 1981 to 2020, the average rate of return was 10.33%. What I want to do here is take a second, and we're going to do a couple of comparisons, bonds to annuities, but just to take a look at where the annuity market has been just in the last 5 years. So if we go back to July of 2020, which was really a very, very low point in the interest rate cycle, for a 65-year-old client, the highest available lifetime income was 5%. So if they deposit $100,000, they could get $5,000 per year payable for the rest of their life. As of 2023, that rate was 7.3%. As of today, you can buy an annuity for a 65-year-old client and generate immediate 7.7% lifetime income. May seem like a relatively small difference between 5 and 7.7%, but that's 54% more lifetime income than you could buy a client 5 years ago. So again, we're at this point in the market where annuities are priced to drive long-term value with an underlying much, much higher interest rate. Now, this is for immediate income. If a client was to defer for a couple of years, you would have roll-up rates and you would have growth rates on what that income would generate. So whether they're taking immediate income or looking to defer income, we are locking in these payouts that are really the highest we've ever seen in the annuity industry. One of the reasons to look at this, so this is from BlackRock. If you go out to BlackRock's website, you can look at forward-looking assumptions. So what are their assumptions as to what markets or what returns are going to be in the future? What I'm focused on here, right here at the top, Bloomberg Barclays US Aggregate Index. This is corporate American investment grade bonds. If you'll note, BlackRock's assumed returns, this is with no fees involved, are 4%, whether you're on a 5-year, 10-year, or 20-year basis. Very little volatility to that. That is the return being projected by the biggest asset manager in the world. So your clients who are holding bonds, if they're not taking on additional risk, if they're not looking at lower credit quality, a solid assumption over the course of the next 20 years is that they'll earn about 4% on that bond portfolio. Bonds tend to come with fees. So if you're managing the assets, we might look at the total return being about 3.5% on those assets that are currently held in bonds. So when you think about bonds, what are bonds really doing for a portfolio? So there's two main things, I think. The first is just to be a diversifier to equities. They're supposed to be a non-correlated asset. We all saw a few years ago that they were correlated really right at the wrong time. But generally, a bond is there to provide stability and provide cash flow. So in today's market, utilizing bonds, you're tending to be able to provide about a 4% coupon-based cash flow. Clients are living a lot longer. So this is a tool that we have available on our website. You can log in, you go to Actuary Lab, you can enter your client's specific information. This is a 60-year-old couple displayed. You can also, by the way, reach out to our teams and say, hey, here's my clients. They can send you back this longevity report. But what we're seeing here for a 60-year-old couple, 65-year-old couple, the male has a life expectancy of age 88, so 23 years. The female age 90, which is 25 years. And then when you look at joint life expectancy, this is the expectancy that one of the two of them will still be alive. So it's not an average between the two. That pushes life expectancy out to about age 93. Now, what you'll notice down here is we list different life expectancy points. Life expectancy can be confused for where we should plan to. There is a 50% chance that one of these two will actually live beyond age 93. So if you look to plan to a little bit more certainty, you might be planning for a 33-year retirement. That's about the 25% point. There's a 25% chance that one of those two 65-year-olds will still be alive at age 98. Now, why this is important is I'm going to take some of today's annuities and we are going to put them into financial terms. So you can really consider, hey, could an annuity maybe be more valuable than a portion of this client's bond money? This is a tool we use. We can run it for you on our website. Looks like my camera disappeared here. Let's see. Anyway, this is a tool that we use. We can quote every single income rider available in the market today. So if you call us and you say, hey, look, I've got a 65-year-old client, I want to drive some income right now, or a 65-year-old client, and I want income to begin in 2 years, we're generally going to go out to this tool. You'll see we've got the first page listed. There's about 140 products on this report. So again, this is our 65-year-old client. We're depositing $100,000. We're looking to begin immediate income. So the top product here from an A+ rated insurer you can see is North American. They're at $7,750. We've got Fidelity and Guarantee at $7,930. As I move forward here, I want to just take a look at what that looks like, because I think annuities tend to really become a confusing product when they really don't need to be. So this is an immediate income rider payout. You can see we're depositing $100,000. Immediately, that payment will begin at $7,700 per year. That $7,700 will be payable for the rest of their life. So again, this is a lifetime income rider. We may notice the balance is decreasing because we're pulling more money out of the contract. But what we can bank on is that we will have a $7,700 payment payable for the rest of their life. One simple point to make there, and I think this is a simple point to make with your clients, is If you have money currently sitting in bonds, and let's say you're spending that coupon payment, you're living on about $4,000 or $5,000 if you're in a little bit more aggressive portfolio right now. So the first thing, if we replace a piece of those bonds, is we can increase that client's income by 50%. Generally, when you talk about increasing a client's income by 50% or taking much larger withdrawals, that comes with the risk of running out of money, right? We're pulling more out of the portfolio. We're going to be eating into principal. The beauty of the annuity is you can tell that client, look, it does not matter what interest rates do in the future. We are locked in at this 7.7% payment for this asset, payable for the rest of your life. When we look at what that means from a peer value standpoint, so this is our IRR tool. Again, many of you have probably seen that. For those that haven't, this is available on Core Connect. You can run it yourself. Generally, we have people calling into our sales team saying, hey, I'd like something for this client. Let's run an IRR on this product. You may be able to run an IRR on an existing annuity. This is a tool to help us value what is that lifetime income actually worth. So again, this is our 65-year-old client. You'll notice we have our life expectancy points embedded into this IRR tool. So this is going to be specific to your client. We've deposited $100,000. The annual income is the 7.7%. So should this client live to life expectancy at age 88, that is a 6.3% internal rate of return on this asset. So we're paying out at $7,700 per year. You'll notice again your principal is decreasing. But if you took that same $100,000 and you told the client, look, I'm going to pay you $7,700 per year, you would need to earn 6.3% net of fees every single year annually in order to produce exactly $7,700. So if you earned 5% net of fees, we'd probably last. As you can see over here, we've got year-by-year IRR. We would run out of money right at about age 84. If you earned 4%, as BlackRock is projecting, we'd run out of money at about age 82. Again, if you subtract a fee, maybe we're running out of money at about age 80. But what today's annuities are allowing you to do is take an asset that's projected to earn about 4%, and move it into something that's the equivalent of earning 6.3% per year over the course of the next 20 or 30 years. So if you believe interest rates may go down, interest rates may stay the same, a move from the bond asset to an annuity to produce your client's spendable cash flow will have a very, very positive impact on their financial plan. A lot of times we end up talking about the remaining balance here, right? I mean, with a bond, clients like the balance does not go down. This is where a little bit of the education piece can come into play. Again, if we take an asset, the bond portfolio may be producing about $4,500 of spendable income. We've got other webinars on this topic as well. What it means to still take this asset and produce $7,700 per year is you are now leaving other assets in place. You don't need to withdraw that extra $3,700 from another asset that experiences greater growth rates. So really, we are not buying the annuity for the account value. We're buying the annuity for the fact that the insurance company will continue to pay you beyond that account value, right? So we can see account value goes to zero. This is the point at which the insurance company is now producing value for you. You're in their pocket. You're getting payments of $7,700 per year. So it's not about what the annuity will do from an account balance standpoint. It's about what the annuity will do from a spendable income standpoint and what it will do to allow assets to remain in other better growth parts of their portfolio for the long term. And we'll get into an example about that in a financial plan in a little bit. A second idea, we've got annuities that don't just produce level income. So you can see the highest annuity on the market right now from an increasing income standpoint. You deposit $100,000. That first payment is now 6.11%. So we're less than the other. We're at 6.11 versus 7.7. Now, This annuity produces pay raises based on the credit to the index. So we're just in a very plain and simple S&P cap at 4.5% on this product. That cap may seem low, but it's because it's built into a product where that 4.5%, when you earn 4.5%, it gives you a pay raise on your income of 6.75%. So notice in this second year, we earned 6.75. My new minimum payment for the rest of my life is $6,522. The next year, you can see, was another gain, so we're 69.63. When we do get another zero, your payment just remains level. So this is a payment that is stepping up. We get out here to year 7, and again, we look at these as very reasonable projections. We're using the simple S&P cap. You can use a fixed account in this contract that's paying about 3%, which would just produce a 4.5% pay raise. At this point, you're now getting a payment of 7.9% of your original principal. So with this product, it's a little different than the other product. We're taking an asset, a bond, let's say, that was earning 4 and moving it to 7.7 in the other product. You're just going to get that 7.7 forever. With this product, we are going to get an interest rate or a payment that will rise throughout your entire retirement. So at some point, you can see we reach age 88, our lifetime income age here. We're paid 17.375% of that initial payment. Their money sitting in bonds, still paying them 3.5% to 4%. What is that worth from an IRR perspective? You can see it's 8.7% at age 88 at their life expectancy. Now, this is a product that the pay raises are dictated by returns. There's really no right or wrong answer here. It's different by different ages. If you recall, our straight guaranteed IRR, a payment that cannot change over here, is 6.3%. The increasing income payment is an 8.7% IRR, assuming a 3% return or a 4.5% S&P cap. What I would go through here is on each individual case, you can look at the straight guarantee versus the increasing income. Our team can run an IRR for you on both products. If you'd like, we can dial down the return. We can say, hey, what if the increasing income only grows at 2%? We have people that are splitting cases. Again, in either case here, what we're doing is looking to produce a lot more value than an asset like a bond that might be sitting in their retirement account and potentially under-earning over the course of the next 15 to 20 years. The second piece here, while interest rates are high, I like to describe an annuity much like a mortgage. It's the opposite of a mortgage. So when your client was younger, they went to a bank and they said, hey, give me $200,000 to buy a home, and I'm going to pay you back over the course of the next 30 years. An annuity is the exact opposite. The client gives the insurance company $200,000, and the insurance company pays them back over, let's say, the next 30 years, of course, over the course of their lifetime. When you see clients that refinanced, they took a mortgage, they refinanced from a 5% rate to a 4% rate to a 3.5% rate. We see some people with a 3% 30-year fixed mortgage rate. They're doing that because interest rates have changed, and based on this long-term vehicle, they can have a great impact over the long term. Right now also happens to be about the greatest time in the business to look back at those in-force annuities. And you'd be surprised, we're seeing annuities from 3 to 4 years ago that are maybe already driving income, or they're going to start income in a year or two, where, as in this example, the client had a current annuity. As we analyzed what the current annuity was going to produce, it was $272,000 currently in the account value. In 4 years, this is a joint lifetime income stream. They were going to get paid $15,225. This was a product purchased 4 years ago. And actually, this is an Allianz product. So within the exact same insurance company, the clients wanted to keep this increasing lifetime income. You can see this is still not an unvaluable product. We're still producing a 4.7% IRR at their joint life expectancy. When we compare that to purchasing a new product. We were able to do this transaction within the same insurance company. Let's take this product, product A, and move it over to your newer product with the higher rates and the higher payout factors embedded. It produces an 8% IRR, a starting payment of $19,349. So I go through this because many of you have existing annuities on the books. We certainly need to be looking at every annuity that's 5, 6, 7, 8, 9, 10 years ago. And again, I'm talking about annuities here that are driving lifetime income, where the client's goal is lifetime income. But even products purchased 3 to 4 years ago, it's a great time before interest rates potentially start to fall and payout factors start to go down a bit, to take a look at all of those in-force annuities. We here at Core make that really easy on you. You can send us a statement, tell us a little bit about the client. It's a quick email or a quick phone call to your consultant here at Core. They will take that existing annuity. They'll figure out exactly what the lifetime income payouts are. We have 2 actuaries here that will read the prospectus. So if you've got some version of a variable annuity that's the 3rd version out of 14, they'll go find the exact payouts, exactly what the existing annuity is going to produce. And then they will document for you from an IRR standpoint why potentially a new annuity would be in the best interest of that client. We see a ton of these for clients that are already taking income. It's about the easiest conversation you can have. The client's taking, let's say, $5,000 a year of income or $500 a month of income. We look at a new annuity that's maybe paying them $750 a month. I mean, we're seeing cases where we're stepping the income up 25 to 30%. Again, the client's used to that payment. Clients love higher payments that are still guaranteed for life. So I'm trying to bring a little sense of urgency here. If you have existing annuities, if you have clients that bought annuities from somebody else, let's take a look at these things while we are at an all-time high from a product pricing standpoint, because you are locking a client into something that they can potentially keep for 25 to 30 years at one of the best interest rate environments we've ever seen. So again, use our teams. Any of your existing annuities, could be a variable annuity, an indexed annuity, could be a straight fixed annuity. Any of those products that are looking to drive income for your clients, send them over. Let us do the work. We'll create a great documentation package for you. We'll help you find the absolute best product available today. And then we'll give you a simple math-based conversation you can have with your client as to why you're talking to them about it. So last main overall point, and I think this is the most important point, especially if we're talking about replacing bonds or why we should actually use annuities. So financial planning, we've got teams here that can help you with your planning software if you're not used to building the annuity into a financial plan. I'm going to run through a simple scenario here. This is what we're seeing in almost every case as we introduce an annuity to the financial plan. This is a 66-year-old couple. We've got $1 million, 60-40 portfolio. So we're going to assume 7% return on their equities and 2.5% on their bonds. Again, this is assuming a 1% fee. He has Social Security of $3,000 per month. Hers is $1,500 per month. They want to generate $100,000 a year in annual income in their retirement. One of the ways this software works is it has them enter what percentage of that income would they like to be protected, right? So often a client might be looking to cover their bills, pay a mortgage, food, basic expenses. They would like it to come from a source of income that will always be there for them. Other things like vacations or luxury or different spending, maybe they're more willing to take withdrawals as the market turns. So in this case, we're going to put inflation assumptions at 2%. So this is what most financial plans do, is they make assumptions on forward-looking returns. In this case, these clients look great. After their Social Security, they don't have a huge withdrawal rate from their portfolio. As you can see, what we've got here, this is the balance over the course of their retirement. So let's say they live to age 90. They're going to pass on a significant amount of money to their kids. This is exactly what you hope a financial plan looks like. You can see the yellow line here is their desire for protected income. The lower blue line is their current level of protected income, which is Social Security currently at $4,500 a month for the two of them. Now, here's the catch, right? So inflation been very, very hot. Inflation assumption in this first plan is at 2%. If we bump that inflation just 1%, if we bump up the assumption for inflation to 3%, in this case, the client now runs out of money at age 90. You can see we've got this spendable income shortfall. What can we do about this? In this case, what we're going to do is take the money from bonds, the lower yielding money from bonds. So $365,000, we are going to place it into an increasing income annuity. The idea is that $365,000 is going to get them to exactly their protected income target. So $365,000 from bonds. And we're actually going to take, now that we've got all of our protected income placed, we're going to take that remaining $35,000 from the bonds and we're going to move it into the higher returning equities. We've got our income in place. We don't necessarily need the cash flow or the stability from a bond because we're producing all of that from an annuity with a little less money than we had to have allocated into the bond fund. So now we can see the impact on the plan. Once again, we're now at a spot, their protected income levels are met here. There's a slight shortfall because we've got inflation running a little hotter than Social Security, but we're at the level right at the start. And at this point, the client now has $500,000 or $600,000. They've got assets left at the end of the retirement. What you'll see as you build these into plans, if you've got clients that are retiring and taking withdrawals from their portfolios, maybe they don't like annuities, maybe they don't want to sacrifice the liquidity. Even if you take 10 to 15% of that client's asset, we don't need the inflation adjust in here. You will see that by moving an asset that's assumed to earn 2.5% over the course of their retirement into an asset that's producing a guaranteed IRR of 6.5, 7, 8%, it will have a majorly positive impact on those financial plans. And this is really getting to the overall point of the webinar here. Again, whether it's clients that you intended to potentially put an annuity in place as they get closer to retirement, maybe clients that are already retired that you really wouldn't have considered talking to about an annuity, now is the best time. The simple concept of, hey, we're going to take an asset and we're either going to start driving income right now at a fully guaranteed pace, and it's going to move it into an asset that's really going to improve your overall financial plan. Clients can either spend more, they can feel more certain in retirement, or they can pass on more assets at the end of their life by incorporating an annuity. Again, right now, while we're in a high interest rate environment, that will lock them into those higher rates over the course of the next 25 to 30 years. Okay. One last example, let's say we back the 3 down to 2, so we only have 2% inflation. This is sort of what I was talking about. Now we just have a lot more money left over at the end of retirement. So again, by incorporating the annuity, by moving some money from bonds, which we assume are going to earn anything less than a 6% guaranteed IRR over the course of their retirement, we are simply producing more money that they can either pass on to their beneficiaries, or maybe they can spend 5 to 10 grand a year more in retirement, take more vacations, spend more time with their grandkids. I really do think now is the best time to consider taking some assets of a client's, buying lifetime income, showing them the benefit that it can have over the course of the next 25 to 30 years. You know, to summarize here, annuities, more total yield and cash flow than your current bonds. Using annuities to drive income instead of bonds is going to increase your financial planning success. It's going to leave more money in your growth portfolios and your equities at the end of the retirement. And right now is really the best time to take advantage of this. If you're not working with core income right now, you know, simple phone call, you can see the email down here as well. Just say, hey, I'd like to get a quick 10 to 15 minute introductory Zoom. Our teams are very, very efficient, they're very fast, they're very accurate. You'll find that working with us, somebody will pick up the phone every single time. We will turn these case designs and IRRs around in a matter of hours. But what we're really here to do is to serve you on your mission to help bring your clients financial certainty, to help bring them better financial results. Really appreciate everybody hopping on this webinar. Everybody who currently does business with us, thank you. If you're on here and you're thinking about talking to us, would love to get a phone call or get an email from you and spend 15 minutes together talking about how we can help you achieve exactly what you're looking to, help your clients achieve the retirement of their dreams. So thanks so much. Appreciate you joining me today, and have a great day, everyone. Take care.